Back in 2008, the whole global economy was just in free fall. And to make things even worse, the very tools the folks at the Federal Reserve used to steer through these kinds of things, well, they broke. So today we're going to break down this incredible paper that basically built them a brand new compass, one that's designed to work right in the eye of the storm. And this isn't just some made-up scenario. This is pretty much exactly what the U.S. Federal Reserve was up against in 2008. I mean, here they are, trying to steer through the worst economic crisis we've seen in generations. And their most trusted instrument, it just completely failed on them. So for decades, right, the Fed's go-to tool was something called the federal funds rate. You can just think of it like a simple dial on a machine. If the economy was running too hot, they turn the rate up. If it was sluggish, they turn it down. Simple enough. But the 2008 crisis, it was so bad they had to crank that dial all the way down to zero, and it just got stuck there for years. Their main compass was officially completely broken. So with their main steering wheel basically jammed, how on earth did the Fed even start to navigate a storm this bad? I mean, we're talking about the worst one since the Great Depression. Okay, so this whole situation, it actually has a name. Economists call it the zero lower bound. And it was a huge, huge problem. Why? Because it meant that the old, reliable way of figuring out what the Fed was doing, just looking at that interest rate, was now totally useless. Think about it. A rate of zero doesn't tell you if policy is getting tighter or looser. It just tells you you've hit a brick wall. So the Fed had to get really creative, really fast. They started using these new, what they called unconventional policies. You've probably heard of the big one, quantitative easing, or QE. It's kind of a fancy term for the Fed basically printing new money to buy up a ton of government bonds. And in doing that, they're pumping cash right into the financial system. But this created a whole new challenge. How do you even know if these weird, new, complicated actions are actually doing anything? I mean, for all intents and purposes, economists were flying blind. The central question became, how can you possibly measure what you're actually doing with monetary policy when your main gauge is broken, and you're just trying out all these brand new experimental tools? They desperately needed a new compass, and they needed it like yesterday. All right, so let's get into the solution that this paper comes up with. Because if your old compass is busted, maybe you can find a new way to see where the ship is going by using a totally different kind of map. And this is where the researchers had a really, really clever idea. See, the federal funds rate, that's basically the price of money, right? The price of borrowing it. And they thought, hang on, what if we just stop looking at the price of money and instead we start tracking the quantity of money? The total amount of cash actually floating around in the economy that people can spend. So this idea has a name. It's called a monetary aggregate. And it's really just a measure of all the spendable stuff that's out there. And we're not just talking about physical cash in your wallet. It includes all the money in your bank accounts and other stuff you can turn into cash really fast to buy things. It's like a giant shopping basket for the whole economy. And these researchers, they decided to focus on a really, really broad version of this basket. The specific tool they landed on is called Division M4. We'll just call it DM4. And what's so special about it? Well, it's incredibly broad. But what's really crucial is that it's crisis-aware. It tracks things like commercial paper and repo agreements, which I know sound complicated, but they're basically the very things that were at the heart of the 2008 meltdown. They were the pipes in the financial system that just completely froze solid. So by watching DM4, you could finally see if the Fed's emergency measures were actually getting things flowing again. Okay, so it sounds like a great idea, right? But does this new compass actually work? Well, the researchers put it to the test. So, first things first, they checked it against the good old days, the normal times before the crisis. And what they found was awesome. In these calm waters, the new compass, the DM4 model, gave readings that were pretty much identical to the old compass. Both of them were pointing in the exact same direction. So far, so good. The new tool checks out. But, and here's where it gets really interesting. As they got closer and closer to the 2008 storm, the old tool started to go haywire. It started spitting out these bizarre results that economists call puzzles, which is a nice way of saying they made absolutely no sense. Like, it would suggest that tightening monetary policy would somehow make prices go up. It was completely backwards. But the new tool, the DM4 model, it stayed steady. It kept pointing true. And this is exactly why the authors of the paper could say, and I'm quoting here, that their model's responses are free from price, output, and liquidity puzzles that plague other approaches. I mean, it was proving itself to be way more dependable, especially when things got really turbulent. And then you get to this chart. And this is really the aha moment for this new model. What you're seeing here are the DM4 readings during the absolute peak of the crisis. And just look at it. It lines up perfectly with reality. You see these huge spikes? Those are the exact moments the Fed announced QE1, QE2, and QE3. And then, see that big drop? That's the taper tantrum in 2013 when markets freaked out. The new compass wasn't just working, it was mapping the storm in real time with incredible accuracy. So now that we have a tool that we know we can trust, we can use it to ask a really powerful and honestly kind of terrifying question. What did all of those crazy, unconventional Fed policies actually do?
Yeah, the model lets us do something amazing. We can run a what-if scenario, a counterfactual. We can ask, what would have happened if the Fed had just sat on its hands? What if they had let the money supply collapse, just like it did back in the 1930s during the Great Depression?
And the results, well, they're staggering. The solid line there, that's what actually happened. It was a really bad recession, no doubt about it. But that dotted line, that's what the model predicts would have happened if the Fed did nothing. And that's not a recession. That is an economic cliff. We're talking about a Great Depression 2.0 scenario. And let's put a number on that cliff. The model suggests the economy could have shrunk by over 12.5% from its peak. Now, what actually happened was a drop of about 4%, which was already incredibly painful. The difference between 4% and over 12% is just monumental. It's the difference between a crisis and a catastrophe. So what's the bottom line here? It tells us that all those weird, controversial, unconventional things the Fed did, they weren't just tinkering around the edges. According to this model, those actions were the difference between navigating a really, really terrible storm and the entire ship going down, a complete shipwreck for the global economy.
So, let's bring this all home. What's the big takeaway? Why does any of this matter to you and me? Why is having a better compass so important?
Because at the end of the day, this research isn't just about looking back at the last crisis. It's about getting ready for the next one. And let's be real, another economic storm will happen eventually. They're inevitable. But having a reliable compass like this, one that actually works when things get crazy and the old rules don't apply, it gives the people in charge a fighting chance to steer us through it. It means that next time, hopefully, they won't be flying blind. And that matters to every single one of us.